This is Barry Zalma speaking for Claim School Incorporated, Zalma on Insurance blog. Today we'd like to speak about an insurance agent who should never attempt to sell unregistered securities, especially when the liability insurance policy carried by the agent has an unregistered security exclusion, which defeats both the duty to defend and the duty to indemnify. William Saoud sold insurance-related products. Beginning in 2017, he offered some of his clients a new financial instrument, a Memorandum of Indebtedness issued by One Global Capital, LLC. The investment opportunity was too good to be true. In William Saoud and Patricia Boland Saoud versus Everest Indemnity Company, the United States Court of Appeal for the Sixth Circuit on July 14, 2022, resolved the insurance coverage issue. Global Capital declared bankruptcy, and the SEC sued the company for alleged violations of the Securities and Exchange Act. Saoud's clients also sued him. Saoud sought indemnification from Everest Indemnity Insurance Company and ultimately sued seeking a declaratory judgment and breach of contract. The district court granted summary judgment in favor of Everest, concluding that the claims related to One Global Capital did not fall within the scope of the insurance policy. Several clients sued Saoud and his wife, Patricia, who was also an employee of the firm. Their complaints generally alleged that the Saouds had falsely represented that One Global Memorandum of Indebtedness was a secure investment and had sold an unregistered security in violation of Michigan's security laws. On February 19, 2019, Saoud Financial notified Lancer of two additional lawsuits filed by clients and of investigations by Michigan's Department of Licensing and Regulatory Affairs and the SEC. Saoud Financial claimed expenses of over $100,000. Lancer, the adjuster, and Everest never responded to the notice. Being in limbo as to Everest's position on coverage, Saoud Financial reached out again to Lancer and notified it of an upcoming mediation so that Everest could participate, but the Saouds never heard from Lancer or Everest. The Saouds eventually settled the lawsuits with their own funds. On July 10, 2019, the Saouds and Saoud Financial sued Everest in Michigan State Court, claiming breach of contract and seeking a declaratory judgment. Everest moved the suit to federal court and finally notified the Saouds that it would not defend or indemnify them for the lawsuits because, in its view, the claims did not fall within the scope of the policy. The district court ultimately granted summary judgment to Everest, concluding that a coverage exclusion applied. The Everest policy included an unregistered security exclusion. That provision excludes coverage for any claim, quote, based upon, attributable to, or arising out of the use of or investment in any security that is not registered with the Securities and Exchange Commission, close quote. The parties disputed whether One Global Memorandum of Indebtedness was a security within the meaning of the exclusion. The district court explained that a note is presumed a security under the SEC and concluded that One Global Memorandum of Indebtedness was a note. The court also confirmed, after ordering supplemental briefing, that One Global Memorandum of Indebtedness was a security because it was not a note that matured in 9 months or less, and even if it was, the One Global Memorandum of Indebtedness was not commercial paper. The Saouds argued that the unregistered security exclusion applies only if the complaints alleged that the Saouds sold securities that were required to be registered with the SEC and concluded that the security exclusion didn't apply. The Saouds argued that the waiver or estoppel should preclude Everest's reliance on the unregistered securities exclusion because Everest failed to timely disclaim coverage. In limited circumstances, of course, Michigan courts, like most, prohibit insurers from raising defenses to coverage that they would and could have raised earlier. But this doctrine cannot broaden the coverage of a policy to protect the insured against risks that were not included in the policy or that were expressly excluded from the policy. Everest never represented the Saouds in the underlying litigation, and therefore never controlled the Saouds' litigation strategy to their detriment, nor have the Saouds provided any evidence of actual prejudice from Everest's delay in informing the Saouds that it would neither defend nor indemnify them. Instead, they argue that prejudice should be presumed. No presumptive prejudice applies, and Everest therefore did not waive the right to raise the exclusion. Finally, the Saouds appear to argue that even if Everest had no duty to indemnify, it nonetheless had a duty to defend. Of course, the duty to defend is not limited by the precise language of the pleadings, nor limited to meritorious suits, and may even extend to actions which are groundless, false, or fraudulent, so long as the allegations against the insured even arguably come within the policy coverage. Contrary to the Saouds' argument, the duty to defend is not unlimited. The insured is not required to receive a defense from the insurer against claims for damage expressly excluded from policy coverage. In other words, there is no duty to defend if there is no duty to indemnify as a matter of law. All of the claims against the Saouds were premised on the same unregistered security. Both the duty to defend and the duty to indemnify turn on whether the unregistered security exclusion applies, because the Sixth Circuit concluded that the exclusion applies. Everest had no duty to defend. In my opinion, Everest had an effective exclusion. It refused to defend or indemnify and basically ignored its insured after telling them it wouldn't do so. Although the duty to defend is broad, it is not unlimited. Since there was no duty to indemnify, there was no duty to defend, especially when it was determined they were defrauding their clients, selling the unregistered securities, and that fraud should never be an action where insurance protects the fraudster. Or fraud would be rampant because there'd be no downside to committing fraud. This video was adapted from my blog post from Zalma on insurance, which is available free to the world. Thank you for your attention.